Welcome back to the Daily Crypto Deep Dive. Bitcoin was never supposed to pay income. It does not pay a dividend, it does not pay interest, it does not pay staking rewards, and it does not behave like a bond, a savings account, or a traditional cash-flowing asset. For years, that was one of the biggest criticisms from Wall Street. Bitcoin believers said that was the whole point, because Bitcoin was supposed to be pure digital scarcity. But traditional investors looked at it differently. They asked a simple question. If Bitcoin does not produce income, how do you justify holding it in serious portfolios? Now that argument is changing fast, because BlackRock and Michael Saylor are both trying to solve the same problem. They are both trying to answer the same question. How do you turn Bitcoin from a passive store of value into a financial machine? But they are doing it in two completely different ways. BlackRock is building Bitcoin for Wall Street. Michael Saylor is trying to build Wall Street around Bitcoin. And that difference may define the next phase of the crypto market. Before we get into it, this episode is brought to you by Kraken. If you're looking to buy Bitcoin, XRP, Ethereum, Solana, or build your crypto portfolio properly, you can sign up using the Kraken link in the description. We are also giving away 20 XRP to listeners who sign up through the link, so check that out below. BlackRock's new Bitcoin Income Fund matters because it takes Bitcoin and packages it in a way that traditional investors already understand. The iShares Bitcoin Premium Income ETF is designed to give investors Bitcoin exposure while also generating income through an option strategy. In simple terms, the fund gets exposure to Bitcoin, then sells call options on part of that exposure to collect premiums. That is called a covered call strategy, and it is already familiar to many income-focused investors. The simple way to think about it is this. Imagine a fund owns Bitcoin exposure, but instead of just sitting there and waiting for the price to rise, it sells someone else the right to buy part of that exposure at a set price in the future. In return, the fund receives a premium. That premium becomes income. The trade-off is that if Bitcoin explodes higher, some of the upside can be capped. So investors may receive monthly income, but they might not capture the full move if Bitcoin suddenly surges. That is BlackRock's model. It is clean, regulated, familiar, and easy to explain. It speaks the language of financial advisors, wealth managers, retirees, income investors, and institutions. It is not asking people to believe in Bitcoin as a revolution. It is simply saying Bitcoin can become a useful portfolio asset with income potential attached to it. That is a much easier sell to the traditional finance world. This is why analysts are paying attention. ETF analysts have already pointed out that BlackRock is not just launching another Bitcoin product. It is moving into the income-focused side of the Bitcoin ETF market, and it appears to be doing so with a more competitive fee than some existing covered call Bitcoin products. That matters because when BlackRock enters a market with a huge brand, a lower cost structure, and the iShares distribution machine behind it, it is usually not just testing the waters. It is normally trying to dominate the category. From an analyst point of view, BlackRock's strategy is obvious. It already has IBIT for investors who want simple spot Bitcoin exposure. Now it has BITA for investors who want Bitcoin exposure with monthly income potential. That is how Wall Street expands a market. First, it creates the core product. Then it creates variations for different investor types. Growth investors get one version. Income investors get another. Advisors get something they can plug into client portfolios. Pension-style investors get a product that feels less wild than pure Bitcoin. That is where BlackRock may have a massive advantage over Michael Saylor. BlackRock does not need investors to fully believe in Bitcoin as a new monetary system. It only needs them to believe that Bitcoin can play a role inside a modern portfolio. That is a lower barrier. It makes Bitcoin less ideological and more practical. In other words, BlackRock is making Bitcoin boring. And for institutions, boring is powerful. Michael Saylor's approach is completely different. He is not trying to make Bitcoin comfortable for Wall Street by turning it into a neat income ETF. He is trying to convince Wall Street that Bitcoin should become the foundation of the financial system. His view is that Bitcoin itself should not change. No Ethereum-style staking, no protocol yield, no inflation-based rewards, no altering Bitcoin's base layer simply to make it look more attractive to income investors. Saylor's argument is that Bitcoin's strength is its purity. Bitcoin is scarce, neutral, hard, and predictable. It is not a company, not a bank, not a bond, and not a tech stock. It does not need to promise yield to justify itself. In his framework, Bitcoin is the base layer of digital capital. The yield does not come from Bitcoin itself. The yield comes from the financial structures built above Bitcoin. That means corporate treasuries, preferred shares, Bitcoin-backed credit, capital markets products, and public companies using Bitcoin as reserve capital. In simple terms, Saylor is saying, do not turn Bitcoin itself into a yield product. Keep Bitcoin pure, then turn everything else into a Bitcoin-backed product. That is the major difference between the two approaches. BlackRock says, here is a Bitcoin income ETF. Saylor says, here's a new Bitcoin capital market. This is where the battle gets interesting because BlackRock probably wins the mainstream investor first. If you are a normal investor, a financial advisor, or someone managing money for clients, BlackRock's approach is easier to explain. You can say this fund gives Bitcoin exposure, sells options, and aims to generate income. That is simple. It fits inside the existing system. It sits inside a brokerage account. It comes with a familiar ETF wrapper. It has a major asset manager behind it. It does not require investors to understand Bitcoin-backed preferred shares, corporate leverage, convertible debt, or Saylor's long-term monetary thesis. But Saylor may win the philosophy battle. Hardcore Bitcoin investors do not necessarily want Bitcoin transformed into a capped upside income product. They do not want Wall Street packaging the asset, shaving fees off it, selling options against it, and presenting that as the future of Bitcoin. They want Bitcoin to remain Bitcoin. From that point of view, Saylor's model is far more aligned with the original Bitcoin thesis. He is not saying Bitcoin needs to pay yield. He is saying Bitcoin is the collateral, the reserve, and the hard asset underneath a new kind of financial system. That is why Saylor's strategy is so powerful, but also why it carries more risk. Analysts and critics have raised questions about strategy's valuation, its premium to the value of its Bitcoin holdings, and whether investors should pay extra for exposure to a company that owns Bitcoin when they can simply buy Bitcoin or a spot Bitcoin ETF directly. That is the bear case. The argument is that strategy could become overvalued if the market treats it as more than the Bitcoin it holds. The bull case is very different. Supporters argue that strategy is no longer just a Bitcoin holding company. It is trying to become a Bitcoin capital markets company. Investors are not only valuing the Bitcoin on the balance sheet, they are valuing the machine that can raise capital, issue securities, structure products, and keep accumulating Bitcoin over time. So the real question is whether strategy is simply a leveraged Bitcoin vehicle, or whether it is becoming the first major Bitcoin native financial company. There is another important risk here. Bitcoin does not naturally produce cash flow. So when companies or funds build yield around Bitcoin, that yield has to come from somewhere. In BlackRock's case, the yield comes from selling options. That is clear and transparent. Investors give up some upside in exchange for income. In Saylor's case, the yield comes from corporate finance structures, preferred shares, capital raises, and the market's willingness to keep funding the Bitcoin treasury model. That can be very powerful in a rising Bitcoin market, but it can also be tested if Bitcoin stays weak for too long. If Bitcoin rises from $66,000 to $100,000, then $150,000, then $250,000, Saylor's model looks visionary. The collateral base expands, the balance sheet strengthens, the market rewards the strategy, and more companies may try to copy it. But if Bitcoin falls sharply or stays flat while capital markets tighten, the model becomes harder to sustain. That is why some analysts see BlackRock's model as safer and Saylor's model as more explosive. BlackRock offers controlled exposure. Saylor offers asymmetric conviction. So who actually wins? For ordinary investors, BlackRock probably wins. It gives them access, structure, income potential, and familiarity. For true Bitcoin believers, Saylor wins, because he protects the purity of Bitcoin and argues that the financial system should adapt to Bitcoin, not the other way around. For institutions, BlackRock likely wins first, because institutions usually move slowly and prefer regulated wrappers, liquidity, compliance, and established brands. But for long-term Bitcoin maximalists, Saylor may win later if Bitcoin really does become the world's dominant digital reserve asset. The final verdict is that BlackRock wins the product battle, Saylor wins the vision battle, but Bitcoin wins the war. BlackRock brings credibility. Saylor brings conviction. BlackRock brings advisors, institutions, and income investors. Saylor brings the treasury model, corporate adoption, and the idea of Bitcoin-backed credit. BlackRock makes Bitcoin easier to own. Saylor makes Bitcoin harder to ignore. And that is the bigger story. This is not really just BlackRock versus Saylor. It is Wall Street discovering that Bitcoin can be more than a price chart. It can become collateral, an income strategy, a treasury asset, a credit base, and the foundation underneath new financial products. But investors need to understand the trade-offs. BlackRock's Bitcoin Income Fund may be useful, but it is not the same as simply owning Bitcoin. If Bitcoin rips higher, covered calls can limit the upside. Saylor's Bitcoin framework may be visionary, but it is not risk-free. If Bitcoin falls hard or funding conditions tighten, aggressive Bitcoin treasury strategies can come under pressure. That is why this moment matters. BlackRock is not just launching another fund. Saylor is not just making another Bitcoin argument. They are both showing us what the next phase of Bitcoin could look like. One path is Bitcoin inside Wall Street. The other path is Wall Street built on Bitcoin. And if both paths grow at the same time, Bitcoin may become far more important than most people realize. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.